There's a number that explains everything. Not the price of Bitcoin, not the federal debt, not the inflation rate, the unemployment rate, the yield on the 10-year treasury, or the market capitalization of the S&P 500. The number is 35. $35 per ounce of gold. That was the fixed price, guaranteed, convertible, redeemable on demand, that the United States government promised to every foreign central bank on earth. From 1944 until the night a president went on television and ended the promise with 11 words. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar. August 15th, 1971. A Sunday night. Richard Nixon, in a 17-minute address to the nation that he framed as an economic rescue, did something that no economics textbook assigned in American high schools explains with adequate clarity. He broke the anchor. Everything that has happened to wages, debt, housing, education, inequality, fertility rates, and the purchasing power of a dollar since that night flows from that single decision. Every chart that diverges in the early 1970s, and there are dozens of them, all pointing in the same direction, has its inflection point in that moment. The productivity line kept climbing, the wages line stopped, the debt line went vertical, the housing affordability line inverted, the fertility line dropped, every single one of them, the same year. And 53 years later, in 2008, a pseudonymous programmer called Satoshi Nakamoto published a 9-page document that began with a problem statement that reads, in retrospect, like a direct response to what Nixon did in 1971. The root problem with conventional currency is all the trust that's required to make it work. This video is the straight line between those two events. By the end of the next 30 minutes, you will understand why Bitcoin is not a technology story. It is not a speculation story. It is not a story about Elon Musk or BlackRock or institutional adoption or ETF inflows, though all of those things matter, and we will get to them. Bitcoin is the monetary answer to a monetary question that was created on August 15th, 1971. And if you do not understand what happened in 1971, you do not understand Bitcoin. Let's start at the beginning. July 1944. The Allied powers have not yet won the war, but they are winning it. And the economists and finance ministers of 44 nations gather at the Mount Washington Hotel in Bretton Woods, New Hampshire, to build the financial architecture of the world they are about to inherit. The central problem they are solving is the problem of the interwar period. The 1920s and 1930s had demonstrated that when currencies float freely against each other, governments manipulate them competitively. Every country devalues to make its exports cheaper. Every country retaliates. Global trade collapses. The Great Depression was not merely a financial crisis. It was, in significant part, a monetary crisis caused by the absence of a credible, stable international monetary system. The solution the delegates construct at Bretton Woods is elegant in its simplicity. Every currency in the world will be fixed to the US dollar. The US dollar will be fixed to gold at $35 per ounce. The United States, which at that moment held approximately 20,000 tons of gold, roughly 2/3 of all monetary gold on Earth, will guarantee convertibility on demand. Any foreign central bank that accumulates dollars and wants gold instead can show up at the Federal Reserve and exchange them at the guaranteed rate. John Maynard Keynes, the most influential economist of the 20th century, representing the British delegation, argued against this structure. He proposed a neutral international reserve currency called the Bancor, issued by a supranational institution, not subject to the fiscal decisions of any single government. The Americans, who had the gold and therefore the leverage, overruled him. The Bretton Woods system also created the International Monetary Fund and the World Bank, institutions designed to manage exchange rate stability and fund reconstruction. It was the most ambitious attempt in history to build a rational, rules-based international monetary system. And for 25 years it worked. The post-war reconstruction of Europe and Japan generated genuine demand for American goods and American dollars. The United States ran trade surpluses. The dollar was credible. Convertibility was credible. The fixed rate of $35 per ounce was credible because the United States had the gold to back it. And then the 1960s happened. The space race, Vietnam, Lyndon Johnson's Great Society programs, Medicare, Medicaid, food stamps, federal education funding, all of which were legitimate policy objectives and all of which cost money. The United States began running fiscal deficits. The Federal Reserve, under pressure from the Johnson and then Nixon administrations, kept monetary policy looser than the Bretton Woods rules strictly permitted. Dollars began accumulating abroad faster than American gold stocks could cover them. By 1965, French President Charles de Gaulle, who understood monetary history with a clarity that most contemporary American politicians did not, began publicly denouncing what he called America's exorbitant privilege. The United States, he argued, was printing dollars and exchanging them for real goods, real assets, real industrial output from France and Germany and Japan, backed by a gold guarantee that was becoming increasingly fictional. De Gaulle was not wrong. He ordered the Banque de France to convert French dollar holdings to gold. Other governments began to follow. American gold reserves, which had been approximately 20,000 tons in the mid-1950s, were by 1971 down to approximately 8,000 tons. The run on Fort Knox was not dramatic. It was quiet. It was conducted through the orderly mechanism of the Bretton Woods system itself, central banks presenting dollars for conversion at the guaranteed rate. And it was draining the gold that made the dollar's promise credible. In the summer of 1971, the British government requested the transfer of $3 billion in gold from Fort Knox to the Federal Reserve in New York. The French had sent a warship to New York to collect their deposits. On Friday, August 13th, Nixon assembled his senior economic advisors, Treasury Secretary John Connally, Federal Reserve Chairman Arthur Burns, Paul Volcker, and 12 others, at Camp David for a secret weekend meeting. 2 days later, Nixon went on television. The speech Nixon gave on August 15, 1971, is one of the most consequential and least understood documents in modern economic history. Nixon framed the address as a defense of the dollar against international speculators. He announced 3 measures simultaneously. First, the suspension of the dollar-to-gold convertibility, described as temporary, a word that has now persisted for 53 years. Second, a 90-day freeze on wages and prices to fight inflation. Third, a 10% surcharge on all imports. He did not use the word devaluation. He described this suspension of convertibility as a defense of the dollar's strength, not an admission of its weakness. He blamed international speculators and unnamed foreign governments for attacking the dollar. He assured Americans that this temporary measure would stabilize the economy and restore prosperity. The Nixon Library preserves the full text and audio of the address under its original title, The Challenge of Peace. The Federal Reserve Bank's historical archive documents the moment plainly. On August 15, 1971, the convertibility of the dollar to gold was officially suspended, ending the Bretton Woods system. Not temporarily suspended, ended. What Nixon did in 17 minutes of television was transform the foundational nature of every dollar on Earth. Before August 15, 1971, a dollar was a claim on a fixed quantity of gold, redeemable on demand, backed by the most credible promise a government had ever made in the history of modern finance. After August 15, 1971, a dollar was a piece of paper backed by nothing but the credibility of the United States government. No gold, no fixed anchor, no external constraint on how many dollars the Federal Reserve could create. This is not a political observation, it is a structural one. The removal of the gold anchor did not just change monetary policy, it changed the fundamental nature of money itself for every person on Earth who used dollars, held dollars, earned wages denominated in dollars, or saved for retirement in assets priced in dollars. And the charts that diverge in 1971 are not coincidences. They are the visible signature of what happens when you remove the external constraint on money creation and allow fiscal and monetary authorities to expand the supply of money without limit. The productivity line and the wages line had tracked together essentially in parallel from 1948 to 1971. From 1971 onward, they diverge. The Economic Policy Institute, using Bureau of Labor Statistics and Bureau of Economic Analysis data, documents this divergence with precision. From 1979 to 2025, productivity increased approximately 90.2%, while typical hourly compensation grew only 33%. Before 1971, the worker captured the gains of his own increased output. After 1971, something else captured them. The public debt line in 1971 stood at approximately $398 billion. In October 2025, the national debt crossed $38 trillion. That is a 9,500% increase in 54 years. The debt-to-GDP ratio, which was approximately 35% in 1971, exceeded 125% in 2026. The dollar's purchasing power, measured by the Bureau of Labor Statistics CPI calculator, has fallen approximately 88% since 1971. $100 in 1971 purchases the equivalent of approximately $12 of goods today. The BLS number is not a theoretical construct. It is the documented, measured, official government accounting of how much the currency that Nixon called strong has weakened. The social data follows the monetary data with a precision that should disturb anyone who believes economic systems are separable from human outcomes. The U.S. fertility rate was approximately 2.48 in 1971. By 2025, it had fallen to approximately 1.62, well below the replacement rate of 2.1. The median age at first marriage for men was approximately 23 in 1971. By 2025, it had risen to 30.8. For women, from approximately 21 to 28.4. The Case-Shiller adjusted data shows that home prices have grown many times faster than median wages since the early 1970s. These are not separate trends. They are the downstream social consequences of a monetary system that, since 1971, has systematically transferred the gains of productivity from labor to capital, from wages to assets, from the people who produce things to the people who own the money that prices everything. WTFhappenedin1971.com, a website that compiles these divergences with direct links to their original government data sources, does not make an argument. It simply shows you the charts, 60 plus of them, all pointing at the same year. Here is the question that most explanations of 1971 do not adequately answer. If the dollar lost its gold backing in 1971, why didn't it collapse? If the fundamental anchor of Bretton Woods, the promise that dollars could be exchanged for gold at a fixed price, was removed, why did the dollar remain the global reserve currency? Why did foreign central banks continue to accumulate dollar reserves rather than diversifying into other assets? The answer is Henry Kissinger and oil. Between 1972 and 1974, Nixon's Secretary of State conducted a diplomatic negotiation that was never a formal treaty, never voted on by any legislature, never subject to public debate in any democracy, and has governed the structure of global finance for the last 50 years. In June 1974, the United States and Saudi Arabia announced the Joint Economic Commission, described publicly as a framework for economic cooperation. What Bloomberg documented in 2016, drawing on declassified Treasury documents obtained through Freedom of Information Act requests, was the actual substance of the arrangement. The United States would provide military protection to the Saudi regime, hardware, naval presence in the Gulf, security guarantees for the House of Saud, in exchange for Saudi Arabia investing billions of dollars of its oil revenues in U.S. Treasury bonds. Within a year, all OPEC members had agreed to price oil exclusively in U.S. dollars, the petrodollar. Oil for dollars, dollars recycled into Treasury bonds. The commodity that every industrial economy on Earth required to function, approximately 100 million barrels consumed globally every day, would be sold in one currency and one currency only. The mechanism this created is the most important structural feature of global finance that most people have never heard explained clearly. Every country that needs oil, which is every country with an industrial economy, which is every country, must first accumulate dollars. At current prices, that is approximately $8 to $10 billion per day in structural oil-related dollar demand, $3 trillion per year in transactions that must pass through the dollar system regardless of what the Federal Reserve does, regardless of what America's fiscal situation looks like. Those dollars flow to the Gulf states as oil revenue. The Gulf states, under the implicit terms of the petrodollar arrangement, recycle those dollars into U.S. financial assets, Treasury bonds, equities, real estate. The Asia Society Policy Institute described this mechanism precisely in its January 2025 report. The petrodollar system rests on three pillars: oil priced in dollars, transactions settled in dollars, and oil revenues recycled into dollar-denominated assets. That recycling mechanism is the plumbing that has allowed the United States to fund its deficits at interest rates that do not reflect its actual fiscal risk. Without it, the United States must either raise interest rates high enough to attract voluntary buyers of its debt, which at current debt levels would trigger a fiscal crisis, or have the Federal Reserve monetize the debt by creating dollars. Either option is painful. The petrodollar has allowed America to avoid that choice for 50 years. It replaced gold as the anchor, not a physical anchor, a geopolitical one. The dollar's value was no longer guaranteed by convertibility to a commodity. It was guaranteed by military power and the structural necessity of oil trade. And this is where the architecture of the post-1971 system becomes visible in its full design. Gold anchor breaks in 1971, petrodollar anchor constructed by 1974. The dollar survives the transition, not because the underlying fiscal problem was solved, but because a new mechanism was built to sustain demand for dollars, regardless of fiscal conditions. The debt could keep growing, the money supply could keep expanding. As long as the petrodollar arrangement held, external demand for dollars was structurally guaranteed, until it wasn't. But that is the subject of another video, one already published on this channel, about Professor Zhang Shuiqin's third prediction. This video is about what the architecture of the post-1971 system actually is, and about why, when you understand that architecture, Bitcoin becomes not an investment thesis, but a logical necessity. Now listen, if you have made it this far into a video that started at Bretton Woods in 1944, you are a specific kind of person. You are someone who understands that economic outcomes are not random, that when wages and productivity diverge for 50 years, that divergence has a cause, that when a dollar loses 88% of its purchasing power in 54 years, that loss has a mechanism, that when the public debt grows from $398 billion to $38 trillion, that growth has a structural explanation. You are the exact audience this channel is built for, and I genuinely want to get to know you. Because we are unpacking the architecture of the entire global system together, I would love to know exactly who is sitting across the screen from me. Please drop a quick comment below with your city, your local time, and what the weather looks like outside your window. Honestly, reading your comments and seeing the global intelligence of this community is one of the absolute most rewarding parts of producing these deep dives. It reminds me that there are real, focused people out there paying attention to how the board is moving. If you want to leave a signal for everyone else who made it this deep into the mechanism, add these 4 words to your comment. I see the architecture. While you're down there, hit subscribe. The algorithm buries channels that connect 1944 to 2026 in a straight line without fabricating the connection. Your subscription is a direct signal that this work has an audience. Now, let's talk about the answer. On October 31st, 2008, in the middle of the worst financial crisis since 1929, caused in significant part by the monetary conditions that the post-1971 system had created, a person or group of people using the name Satoshi Nakamoto published a 9-page document on a cryptography mailing list. The Bitcoin white paper does not mention 1971. It does not mention Nixon. It does not mention Bretton Woods or the petrodollar or Kissinger. Satoshi was a cryptographer, not an economic historian. The white paper's language is technical, not political, but its opening sentence describes the exact problem that 1971 created with a precision that historians have spent decades trying to articulate. Commerce on the internet has come to rely almost exclusively on financial institutions, serving as trusted third parties to process electronic payments. While the system works well enough for most transactions, it still suffers from the inherent weaknesses of the trust-based model. Read that sentence through the lens of what happened in 1971. The entire monetary system that Nixon created, the fiat dollar, the petrodollar, the Federal Reserve's unconstrained ability to expand the money supply, is a trust-based model. You hold dollars not because dollars have intrinsic value, not because they are convertible to anything fixed, but because you trust that the United States government will maintain their value. Because you trust that the Federal Reserve will not expand supply so aggressively that your savings evaporate. Because you trust that the institutional structure of American monetary governance will protect the purchasing power of your labor. That trust has cost the average American approximately 88 cents out of every dollar they held in 1971. Satoshi's innovation was not primarily technical. The cryptographic components of Bitcoin, hash functions, digital signatures, peer-to-peer networks, had all existed before 2008. The technical innovation was the combination of those components into a system that solved the double spend problem without a trusted third party. But the deeper innovation was monetary. Bitcoin eliminates the trust requirement by replacing institutional credibility with mathematical proof. You do not need to trust a government to maintain the value of Bitcoin. The supply is fixed at 21 million coins by the protocol itself, not by policy, not by an institution that can be pressured or corrupted, but by mathematics that runs identically on every node in the network. No president can suspend Bitcoin's convertibility on a Sunday night television address. No Secretary of State can negotiate a geopolitical arrangement that creates artificial demand for Bitcoin through oil trade. No Federal Reserve can expand Bitcoin's supply to fund a fiscal deficit. The Bitcoin white paper was published on October 31st, 2008. Embedded in the Genesis block, the first block of the Bitcoin blockchain, mined by Satoshi on January 3rd, 2009, was a message taken directly from that day's Times of London front page. Chancellor on brink of second bailout for banks. Satoshi did not leave that message accidentally. It is the timestamp that proves the Genesis block was not mined before the date. It is also a statement about what Bitcoin was built in response to. The Chancellor preparing a second bank bailout, the trust-based model requiring, once again, that ordinary people absorb the cost of institutions that had been allowed to expand their risk-taking because the constraint of a fixed monetary anchor had been removed 38 years earlier. The straight line from August 15, 1971 to January 3, 2009 is not a conspiracy theory. It is a design genealogy. Nixon removed the external constraint on money creation. The post-1971 system created the conditions: unconstrained monetary expansion, systematic transfer of productivity, gains from labor to capital, asset price inflation that outpaced wage growth for 50 years. That made Satoshi's problem statement not merely theoretical, but urgent. Bitcoin is the monetary answer to the monetary question Nixon created. Let me give you the numbers precisely, because precision is the difference between a narrative and a case, the productivity wages gap. The Economic Policy Institute, using Bureau of Labor Statistics and Bureau of Economic Analysis data, shows that from 1948 to 1971, productivity and worker compensation grew in near perfect alignment. both rising at approximately 2.4% per year. From 1979 to 2025, productivity increased approximately 90.2%, while typical hourly compensation grew approximately 33%. The divergence, the gap between what workers produce and what they are paid, represents tens of trillions of dollars in compensation that was not paid to the people who generated it. That gap did not disappear. It was captured by capital, by asset owners, by the financial system itself. A monetary system that can expand without constraint systematically advantages those who own assets, whose values inflate with money supply expansion, over those who earn wages, whose purchasing power erodes with the same expansion. The debt explosion. U.S. federal debt in 1971, approximately $398 billion of U.S. federal debt in October 2025, $38 trillion, a 9,500% increase in 54 years. The Congressional Budget Office projects the debt to GDP ratio, which 172% by 2054 under its baseline scenario, the scenario where nothing catastrophically wrong happens. The United States now spends more on federal interest payments than on Medicare or national defense. A country that spends more servicing its past borrowing than it spends protecting its population is a country whose monetary system is consuming itself. The purchasing power destruction. The Bureau of Labor Statistics CPI inflation calculator, the official government tool, shows that $100 in 1971 has the purchasing power of approximately $12 today, an 88% decline. Not in Venezuela, not in Argentina. In the United States of America, whose currency is the global reserve, whose monetary policy is the envy of the developing world, whose Federal Reserve is considered the most credible central bank on earth. The social consequences. The U.S. fertility rate in 1971, approximately 2.48. In 2025, approximately 1.62, below replacement. The median age at first marriage in 1971, approximately 23 for men, 21 for women. In 2025, 30.8 for men, 28.4 for women. The proportion of income required to purchase a median home, approximately 3.5 times annual median income in 1971, exceeding 7 times in 2026. These are not cultural phenomena independent of economics. These are the downstream social consequences of a monetary system that has made it progressively harder to achieve the economic stability that family formation requires. The WTF happened in .act71.com compilation, which sources every chart directly to BLS, FRED, CDC, Census Bureau, and UN Population Division data, shows more than 60 separate economic and social indicators that changed direction in the early 1970s, all of them, simultaneously. The argument that this is coincidence requires you to believe that 60 independent economic and social phenomena, tracked by independent agencies using independent methodologies, all happen to inflect in the same 3-year window for unrelated reasons. The argument that 1971 caused it requires you to believe that removing the external constraint on money creation has systematic, predictable, documented effects on the distribution of economic outcomes. One of those arguments requires more faith than the other. The mainstream financial media covers Bitcoin as a price story. Retail investors cover Bitcoin as a return story. Institutional investors increasingly cover Bitcoin as an allocation story, a portfolio construction decision. All of those frames are incomplete. Bitcoin is a monetary properties story, and the properties are specific, verifiable, and in direct contrast to the properties of the post-1971 monetary system. Fixed supply. The Bitcoin protocol hard caps total supply at exactly 21 million coins. Not approximately 21 million, not 21 million, subject to revision by a committee meeting. Exactly 21 million, enforced by every node in the network simultaneously. The U.S. Geological Survey estimates above-ground gold stocks grow at approximately 1.5% per year from mining. Gold supply is fixed only in the sense that extracting more of it is expensive, not in the sense that its quantity is mathematically determined. The dollar's supply has no fixed limit whatsoever. Bitcoin's supply is fixed the way 2 + 2 = 4 is fixed. Predictable emission. Bitcoin's supply schedule is not only fixed in total, but predictable in timing. New Bitcoin is created only through mining at a rate that halves approximately every 4 years. The halving events. The current emission rate is approximately 0.85% annually, declining to approximately 0.4% by 2028. Every market participant on Earth can calculate exactly how many Bitcoin will exist on any future date. No central bank committee, no emergency measures, no Sunday night television addresses, no counterparty risk. When you hold Bitcoin in self-custody, controlling your own private keys, there's no institution that can freeze your holdings, confiscate your assets, or deny you access to your money. The G7's freezing of approximately $300 billion in Russian foreign exchange reserves in 2022 demonstrated definitively that dollar assets held in Western custody are subject to political confiscation. Venezuela's gold held in the Bank of England was frozen. Argentine dollar accounts were frozen in 2001 during the Corralito. Bitcoin held in self-custody cannot be frozen by any government that does not control the private keys. This is not a theoretical property. It is a mathematically enforced one. No permission required. There are no capital controls on Bitcoin, no government approval required to hold it, transfer it, or move it across borders. In a world where capital controls are a standard tool of monetary management, China maintains them explicitly. Argentina imposed them during its currency crises. India restricts gold outflows. Bitcoin is the only asset that crosses every border with equal freedom. Global settlement. Bitcoin transactions settle with finality in under 1 hour. Cross-border wire transfers take 1 to 5 business days, pass through multiple correspondent banks, are subject to compliance review by each institution in the chain, and can be blocked by any regulatory authority with jurisdiction over any bank in the settlement path. Bitcoin settlement is peer-to-peer, requires no intermediary, and cannot be intercepted by any institution with no access to the private keys involved. These properties are not marketing claims. They are the documented technical architecture of the system, verifiable by anyone who reads the source code or examines the blockchain. And they are, precisely, the inverse of the properties that the post-1971 system has used to systematically erode the wealth of everyone who holds dollars. There is a specific kind of data point that should change the priors of even the most skeptical observer of Bitcoin's monetary thesis. It is not the price. It is not the retail adoption numbers. It is not the on-chain metrics or the hash rate or the Lightning Network transaction volumes. It is when the institutions that are most deeply embedded in the existing monetary system, the system that Bitcoin was designed to replace, begin allocating to Bitcoin at institutional scale. BlackRock manages approximately $10 trillion. It is the largest asset manager on Earth. It is not a disruptive startup. It is not a crypto-native fund run by ideological Bitcoiners. It is the institution most deeply integrated into the existing dollar-denominated financial system. BlackRock's business model depends on that system continuing to function. And in 2024, BlackRock launched the iShares Bitcoin Trust, IBIT, which accumulated approximately $50 billion in assets under management in its first year, making it the fastest-growing ETF in BlackRock's history. BlackRock's holdings grew from 935 Bitcoin in the second quarter of 2024 to 776,474 Bitcoin by December 2025, a 155.5% increase in 18 months. Fidelity, with approximately $4.5 trillion in AUM. Invesco, WisdomTree, VanEck. 21 shares. The ETF ecosystem for Bitcoin, launched in January 2024 after years of regulatory resistance, brought in approximately $880 billion in trading volume across 12 products by November 2025. Total Bitcoin ETF AUM reached approximately $120 billion. The IBIT alone held approximately $70 billion, roughly 59% of all Bitcoin ETF assets. Harvard University disclosed Bitcoin ETF holdings. The Wisconsin State Investment Board, a public pension fund managing retirement assets for government employees, allocated to Bitcoin ETFs. These are institutions with explicit fiduciary duties to their beneficiaries, operating under legal frameworks that require them to act in the financial interests of the people they serve. They allocated to Bitcoin. Mubadala Investment Company, Abu Dhabi's sovereign wealth fund managing approximately $300 billion, disclosed holdings in BlackRock's Bitcoin ETF in a regulatory filing in February 2025. A government-owned sovereign wealth fund in the Gulf made a deliberate allocation decision to hold a fixed supply, no government issuer asset as the petrodollar arrangement that their government has relied on for 50 years faces its most significant structural pressure. The U.S. government itself declared a strategic Bitcoin reserve in 2025, with Treasury Secretary Bessent confirming in February 2026 congressional hearings that the government will halt all sales of seized Bitcoin and retain existing holdings as a national asset. Approximately $15 billion in Bitcoin. A government that holds $38 trillion in debt, whose fiscal trajectory requires either dramatic revenue increases or monetary expansion, is accumulating a fixed supply asset. Strategy, formerly MicroStrategy, holds approximately 714,000 Bitcoin as of early 2026, funded through equity and preferred stock instruments specifically designed for continued accumulation. The company has not sold a single coin since August 2020. These are not retail investors buying Bitcoin because they saw a price chart. These are the most sophisticated capital allocators on Earth, operating under fiduciary frameworks, making deliberate portfolio construction decisions. And the decision they are making, collectively, is that the fixed supply asset with no government issuer deserves a place in a portfolio alongside, or instead of, the dollar-denominated assets that have lost 88% of their purchasing power since 1971. The monetary thesis for Bitcoin is not purely theoretical. It has been tested in conditions that stress test every property the theory claims. Argentina, inflation of 276% in 2024, per official government data. The peso losing value faster than Argentinians can spend it. Between 2023 and 2024, the total volume of cryptocurrency transactions in Argentina exceeded 91.1 billion, not because Argentinians are Bitcoin ideologues, because when your local currency loses value at 276% annually, the fixed supply alternative with no government issuer is not a speculative investment. It is the rational monetary choice. Venezuela. Hyperinflation reaching approximately 10 million% in 2018, a number so extreme it sounds fictional and is documented by the IMF and World Bank. In 2023, approximately 9% of Venezuela's $5.4 billion in remittances were transferred via cryptocurrencies. The people sending money to Venezuela, diaspora workers in the United States, Colombia, Peru, chose cryptocurrency over the dollar wire transfer system, not because of ideology, but because of cost, speed, and the inability of any sanctioned institution to intercept the payment. Nigeria, capital controls restricting dollar access for ordinary Nigerians. Peer-to-peer Bitcoin trading volumes among the highest in the world per Chainalysis data. Not because Nigerians are early adopters seeking alpha, because when capital controls prevent access to stable value assets, the asset that requires no government permission to hold and transfer becomes monetary infrastructure. Iran. Cryptocurrency ecosystem processing $7.8 billion in 2025 per blockchain analytics. Iranian Bitcoin mining operations using stranded energy from sanctioned oil fields that cannot be sold on international markets. Converting unsellable energy into a globally liquid, sanctions-resistant asset, transmittable across borders without any intermediary that American sanctions enforcement can pressure. Iran is using Bitcoin as monetary sovereignty infrastructure, not as a speculation, as the only asset that satisfies the requirements of a government operating under comprehensive financial sanctions. El Salvador, the first sovereign government to adopt Bitcoin as legal tender in 2021, sustained that adoption through IMF pressure, through Bitcoin bear markets, through significant political and economic turbulence, Bhutan mining Bitcoin using hydropower from the Himalayas, the United States declaring a strategic Bitcoin reserve. These are not proof of concept. They are proof of function. Bitcoin works as monetary infrastructure in the specific conditions that the monetary thesis predicts it will work in: high inflation, capital controls, sanctions, currency debasement, and government asset confiscation risk. The laboratory of the real world has been running the experiment for 15 years. 3 standard objections circulate in mainstream financial commentary on Bitcoin. Each deserves a serious answer rather than dismissal, and each has one. Objection 1. Bitcoin is speculative. It has no intrinsic value. Its price is driven by narrative and retail sentiment, not by fundamentals. The intrinsic value argument for fiat currency, the argument that a dollar has intrinsic value, rests entirely on institutional trust and network effects, not on any physical or mathematical property. The dollar has no intrinsic value that Bitcoin does not also have, and Bitcoin has mathematical scarcity that the dollar demonstrably lacks. The institutional allocation data addresses the speculation characterization directly. Harvard University's endowment, the Wisconsin State Pension Fund, BlackRock's iShares product line, and Mubadala Investment Company do not make speculative allocations. They make analyzed, fiduciarily reviewed, portfolio-constructed allocations. The Datos Insights institutional survey found that institutional investors now characterize Bitcoin as a store of value in a rapidly evolving financial landscape, specifically in the context of inflation concerns and currency debasement. That is the monetary thesis, stated in institutional language. Objection 2. The dollar is still dominant. Bitcoin is marginal. Reserve currency transitions take decades, and the dollar's network effects make any near-term displacement impossible. This objection correctly describes the current state, and then extrapolates it as permanent. The IMF COFR data shows the dollar's share of global foreign exchange reserves declining from approximately 65% in 2016 to approximately 57% in 2024, an 8 percentage point decline during a period of dollar relative strength. Bitcoin does not need to replace the dollar to be an extraordinary store of value. It needs only to capture a fraction of the capital that is structurally diversifying away from dollar-denominated assets. At Bitcoin's current market capitalization, A fraction of ongoing reserve diversification creates mathematically significant price appreciation. Objection 3. Volatility disqualifies Bitcoin as a store of value or reserve asset. An asset that drops 40% in a bear market cannot serve the stability function that monetary assets require. BlackRock's December 2025 research documented Bitcoin's trailing 12-month volatility at approximately 43%, comparable to high-growth technology stocks that are widely held in institutional portfolios. More importantly, Bitcoin's volatility has declined structurally as institutional participation has deepened. The asset's volatility in 2013, when it was a retail-dominated market with a $1 billion total market cap, is not representative of its volatility at a $1.5 trillion market cap with ETF infrastructure and sovereign wealth fund participation. Volatility is a function of market depth and institutional participation, both of which are increasing. Gold was volatile during its own institutionalization process. The objection describes the past rather than the trajectory. The establishment was wrong about the end of Bretton Woods until the night Nixon went on television. It applied the same framework, assuming the current system is the permanent system, to a situation where the pressures had been building visibly for years. The same framework is being applied to Bitcoin today. Let me close by stating the complete argument in its simplest form. In 1944, the world built a monetary system anchored to gold via the dollar. It worked for 25 years because the anchor was credible. In 1971, the anchor broke. Richard Nixon, in 17 minutes of television, ended the convertibility of dollars to gold and created, without a vote of any legislature and without public debate, the first truly unconstrained global fiat monetary system in history. In the 54 years since, the dollar has lost approximately 88% of its purchasing power. The public debt has grown from $398 billion to $38 trillion. Productivity has increased 90%, while wages have increased 33%. The median home price has moved from approximately 3.5 to more than 7 times median annual income. The fertility rate has fallen from 2.48 to 1.62. More than 60 separate economic and social indicators changed direction simultaneously in the early 1970s. These are not coincidences. They are the documented consequences of removing the external constraint on money creation and allowing monetary and fiscal authorities to expand the money supply without limit. In 2008, in the middle of the worst financial crisis caused in part by those monetary conditions, Satoshi Nakamoto published a document that began with a problem statement about the inherent weakness of trust-based monetary systems and proposed a solution built on mathematical proof rather than institutional credibility. Bitcoin has a fixed supply of exactly 21 million coins. It has no issuing government. It has no capital controls. It cannot be confiscated by any institution without the private keys. It settles globally in under 1 hour without any intermediary. Its supply schedule is predictable to the year 2140 and beyond. These are not marketing claims. They are the verifiable technical properties of the system. The institutional infrastructure that now exists, BlackRock ETF with $70 billion AUM, Fidelity ETF, JP Morgan Structured Products, Mubadala Sovereign Wealth Fund Disclosure, U.S. Strategic Bitcoin Reserve Declaration, Strategy's 714,000 coin treasury, confirms that the most sophisticated capital allocators on Earth have evaluated the monetary properties of Bitcoin and made allocation decisions accordingly. The proof of concept data from Argentina, Venezuela, Nigeria, Iran, and El Salvador confirms that Bitcoin functions as monetary infrastructure in exactly the conditions that the monetary thesis predicts: high inflation, capital controls, currency debasement, and government asset confiscation risk. The straight line from August 15, 1971 to the present is not a conspiracy theory. It is a design genealogy. Nixon created a monetary problem with structural, documented 54-year consequences. Satoshi created a monetary solution with structural, mathematical, 54-year relevant properties. If you do not understand what happened on August 15, 1971, the 17-minute television address that removed the external constraint on money creation for every dollar on Earth, you do not understand why Bitcoin exists. If you do understand it, you understand why Bitcoin is not a technology bet or a speculative trade. It is the monetary answer to the monetary question that Richard Nixon created when he closed the gold window. And the answer has exactly 21 million units. Not one more, not one less. If you're still watching this video, you just completed an analysis that ran from Bretton Woods in 1944 through Camp David on August 13th, 1971, through Nixon's Sunday night address on August 15th, through Kissinger's secret petrodollar deal between 1972 and 1974, through 54 years of documented consequences in wages, debt, purchasing power, housing, fertility, and inequality, and arrived at Satoshi's Genesis block on January 3rd, 2009, with the headline from that day's Times of London embedded in it as a timestamp and a statement. No fabricated data, no unsourced claims. Every number attributed to its original source, BLS, Fred, CBO, EPI, IMF COFR, World Gold Council, BlackRock SEC filings, Strategy 8K filings, Mubadala 13F disclosure. The architecture is not hidden. It is in the public record. It has been in the public record for 54 years. So, congratulations. You are the 1% elite. Comment below. I see the architecture, so I can know who you are. Subscribe. Share this with one person who still thinks the dollar's purchasing power loss is an unexplained mystery rather than a structural consequence of a decision made on a Sunday night in August 1971, because Satoshi understood what happened in 1971 and built the answer